QuickBooks Online 2021. Multiple currencies, foreign currency accounts receivable adjusting entry. Let's get into it with Intuit's QuickBooks Online 2021. Here we are in our QuickBooks Online multiple currencies practice problem. In prior presentations, we set up the 30-day free trial to practice with the multiple currencies, which you basically want to do if you can, because once turned on, you can't turn off the multiple currencies. The multiple currencies, as we've seen in prior presentations, can be found in the cog here, and then under the accounting and settings, and then under the advanced settings. We won't go into it back at this point, but if you haven't turned it on, that's where you can turn it on. We're going to be opening up our balance sheet and income statement by going to the tab up top, right-clicking on it and duplicating it. Let's duplicate again, right-click again, and duplicate again. We're going to go down to the reports on the left-hand side. Going to be opening up then the profit and loss. Let's start off with the good old P&L. Scrolling up top, I'm going to bring the dates back to 2020, 01/01/20 to 12/31/20. We're going to go ahead and run that report. Close up the hamburger, hold down Control, scroll up just a bit to get to that 125%. Then to the tab to the left, we're going to go back down to the reports on the left-hand side, this time opening up the BS balance sheet, opening that up. Date range change up top from 01/01/20 to 12/31/20. Run it, run the report, closing up the hamburger. Now, in a prior presentations, we set up the accounts receivable for foreign currency, that in the Canadian dollar. So our currency is in US dollars, that's our home currency, and then the foreign currency for the transaction we put in place, which was an invoice, was in Canadian dollars, and therefore we have this accounts receivable with CAD on the books. If your home currency is something other than the US dollar, same kind of thing, same kind of concept, as long as you kind of recognize where your home currency is. If I go into this accounts receivable here, and we select that and go into it, then of course we're going to see our invoice that we put on the books. We put it on the books saying it's going to be in Canadian dollars. We're going to be receiving in Canadian dollars in the future $42,000 of the exchange rate, as of the exchange rate that the item was put on the books, the invoice. That has a US equivalent of the $27,300, which is what we put it on our books for, because we measure our books in US dollars, even though we're going to be paid in Canadian dollars. So if we close that back out, scroll back up top and go back to our information, there is that side. The other side went on the income statement. So if we go to the income statement or the profit and loss to the tab to the right, we see the 27.3 on the income statement here as well. Now, what's going to happen next, normally, is hopefully we'd receive the payment, of course. So if I go back to the first tab, we would receive the payment, let's say, in foreign currency, and then the QuickBooks system would help us to post the gain or loss upon the receipt of the currency. So to do that, we won't record this, but just to show you the example, if we go back to the first tab, the next step in the process would be to get paid, the get paid step here. And so I would go to the drop down up top, and then go to the receive payment. And we would have to then go into our client, which was Canada 1, which was set up to have foreign currencies. And then I'm going to hold Control and scroll down a little bit, there's our invoice that would tie out. If I was to check that off, then you'd see the similar kind of transaction or change that is happening down below, where it's saying, hey, we're going to get 42,000 in foreign currency units, but the US value is the 33,303.44 as of this date. We're not going to record it as of this date, but just note that difference, because when I recorded it on the books, back when we put the invoice on the books, it was at 27,300. And now we're saying that we're going to have 33,303 as the US dollar equivalent at the point in time we actually get paid in foreign currency units, the Canadian dollar. So that difference between those two would then need to be calculated and recorded in some type of gain or loss account. So that would be the normal kind of process, but I'm not going to record this now because we got one other step that could happen in between those processes. Closing that back up, and I'm going to say leave without saving. If I go back to the balance sheet, hold down Control, I'm going to scroll up to that 125 again. If we have an end of the period reporting, say at the end of the year or at the end of the month, and we might need to revalue the accounts receivable even though we had not yet been paid for it, so that we can present the financial statements. So that's the other step that could come into play. If that's not a problem, meaning your accounts receivable in foreign currency doesn't go across the cutoff period into the year or into the month, you don't have that problem, and you can just basically record the received payment, and the QuickBooks system should record the gain or loss to the proper period. However, if you do have that situation, then you're going to have to record basically an adjusting entry. So let's look at it in Excel first and just check it out. Here's what we have in Excel. We put it on the books, 42,000 times the current exchange rate. We got the accounts receivable then on the books this way. Now let's think about what would happen if we were to sell it on we're going to get paid on 5/30/X1. We're going to pretend this is the end of the period. Let's make it actually 5/31. 5/31 at the end of the time period. Now, for the purposes of the practice problem, it makes sense to do a two-step process just to record the payment that we are receiving, so that we can adjust it in that format. So we'll take a look at that. I'll explain that more as we go. But in terms of what we're going to do in QuickBooks, we're going to assume that we need to adjust it as of the cutoff period, 5/31, before we get paid. Let's say like and 6/1 or something like that, if that were the case. So we'll do the same thing for kind of different purposes. Hopefully it'll make more sense as we do it. So what's going to happen? This is on the books at the 27,300 with a 0.65 exchange rate. Now we're saying as of 5/30, let's say 5/31 here, as of 5/31, the exchange rate is 0.68. So for $1 Canadian, you get 0.68 US dollars, whereas before it was 0.65. That means the Canadian dollar got stronger in relation to the US dollar because $1 Canadian can now purchase more of a US dollar. So for us then, we had a receivable on the books where we're going to get paid in Canadian dollars, and now the Canadian dollar got stronger. So that's basically good for us. That's like a gain for us because we're going to get paid in a currency that got stronger in relation to our currency that we measure in our books. So what's going to happen is the accounts receivable is going to go up. We're going to say the accounts receivable is going to go up. And if we pull out the trusty calculator, there's a couple ways we can calculate it. We could say the 42,000 Canadian dollars times the new exchange rate, which is 0.68. That's the new spot rate, minus what it was before, 27,300. Or we can take then the difference between the exchange rates, 0.68 minus 0.65 times the 42,000. And there's going to be our difference once again. Let's do that with a formula here. I'm going to do it with a formula, and I'm going to say equals brackets. I'm going to take the bigger of the two exchange rates minus the smaller of the two, so we have the difference, brackets, times the 42,000 Canadian dollars. There's the change. There's our debit and credit. The difference is going to go to some type of gain down here because we got a gain on this foreign currency transaction as of this point in time. So foreign currency transaction gain. So what's going to happen? I'm going to record this. I'm going to double click on the receivable, say plus, pick up the 1,260. And then on the other side, I'm going to go down to the gain down here, and we're going to pick up that 1,260. Now, we haven't actually received the money at this point in time. We're revaluing it as of the end of the month here. So there it is at the 28,560, which of course is once again the current exchange rate, the 42,000 foreign currency units, Canadian dollars times the 0.68. So there's the 28,560 that we have here. And then down here, note that we had the sale on the books at the point in time that we made the sale in sales revenue. And then we have the other revenue not recorded in sales, but down here because it was a result of the differences in the exchange rate from the point in time we made the sale to the point in time at this point, that at the end of the period. So we're going to do that same thing over here. Now, this is an adjusting entry. So the desktop version has a nice little feature to help us do just adjusting entries like this. We don't have that same kind of thing for the online version. So we'll just have to do it. We'll just do a journal entry. And basically, I'm going to write up this journal entry to be what it should be at this point in time. So to think about it, you might want to open like an invoice can help you out with this. So I'm going to open up basically an invoice and kind of think about it. So if I right click on this tab to the right and duplicate it, we'll then take a look at an invoice, and we'll just create an invoice as if we're going to make it, in the current time period on 5/30/20. So I'm going to say let's invoice. Obviously, if we were doing this in real time, I could basically pretend I'm going to make an invoice for the Canadian dollars as of the current exchange rate or date, which would be, I'm going to say 05/30/20, and then that would give us the current exchange rate. Now, this being a practice problem, I'm just going to give myself the exchange rate, right? I'm just going to tell me what the exchange rate is. In practice, I would let the system calculate it because it would know the current spot rate, but I'm going to put in the practice problem amount, the 0.68. So let's make this then 0.68. So there we have. I'm just going to use this for one transaction. I don't want it to change everything. And then I'm going to put the same information down below just so I can see the difference between the two invoices. So this was 42,000 Canadian dollars. And so there's my calculation on the difference. That's what we just calculated it to be in the system. Let's compare that then to the prior invoice, the one we actually entered in the prior period. I'm going to drill down on the sales data to see that. And I'm going to go into the sales data here. And I can then look at the other invoice. And this is one way that you can kind of see the two exchange rates, right? I drill down on the one invoice, and there's the one exchange rate at the 0.65 as of that date. There's the amount 27.3. I can obviously take that 27.3 minus this 28,560, and that difference is what I need to make an adjusting entry for. Another way I can think about it is like I can think about it as basically removing the journal entry related to this transaction and then recording the journal entry related to this transaction. So let's just go back to the first tab and test that out. I'm going to hit the plus button here. We're then going to say, let's do a journal entry. And if I was to do this in practice, I might say, okay, I'm going to basically think about recording this invoice kind of like as of the new exchange rate. I'm going to make an adjustment forward. So basically, I might think of reversing this entry and then recording this entry and see if this makes sense to you. And then we'll think about it a different way. So if I was going to put this on the books in US dollars as just a journal entry, I could go back to the first tab and I would say something like, and again, I want to hit another accounts receivable account. I'd rather not have an accounts receivable account as the same accounts receivable account when I'm dealing with the foreign currency transactions. So one way you could do it is put an accounts receivable that's not actually an accounts receivable type of account. So accounts receivable, I'm going to call it, let's call it CADADJ, adjusting entries. So this is my adjustment for the accounts receivable for the Canadian dollars. And then I'm going to go up top. I'm not going to make it an accounts receivable type of account because that requires me to have a particular customer, and I don't want a subledger in this case. So I'm going to use other current assets. That'll put it in a different location on the balance sheet, but the benefit is that we don't have it messing up our subledgers. And so that's what I would like to do then. And then I'm going to go down and say this is going to be an other current asset, and there's the name US dollars. I'm going to keep it then at the US dollar. So I'm going to then say okay, and then I'm going to put the full amount I'm going to reverse like the first invoice. So this would normally be a debit. I'm going to credit it for the 27.3. So I'm going to take this kind of like off the books for the 27.3, and then I'm going to say this is an ADJ entry. And then the other side is not going to go to sales, but rather to some type of gain or loss. So I'm going to call it foreign currency gain/loss. Foreign currency gain/loss. And it'll be an account that will flip one way or the other depending on if it's a gain or loss. I don't want it to be a normal income account. I want it to be on the income statement, but I'm going to put it on the bottom as other income. So that means, notice there's an other income and there's also an other expense type of account here. And you could choose either one of them, but it's going to flip back and forth whether it be income or loss. Otherwise, you have to choose two accounts and have all your gains go into one, losses to the other. I'm going to have it one account flipping back and forth between gain and loss. So I'm going to say okay, and there's the other side of it. And so then I'm going to put the new item on the books, same account. It's going to be accounts receivable, and this is going to be for the adjustment account. I'm going to put it on the books for the one I calculated here. I'm not actually going to record this invoice, but if I was doing this in practice, I would use that invoice to give me the current exchange rate and the current value, and I wouldn't record it. So 28,560 is what we're going to use. We're going to say, all right, this is 28,560. And then I'm going to put the other side to the foreign currency gain or loss. Now this is kind of a long journal entry. You don't have to do it this long, this big type of journal entry. You could net it out. Obviously these two will net out to the adjustment that we had, which was the 28,560 minus the 27,300. So you could subtract those two and then just record what we had on this journal entry, which was debit accounts receivable and credit the foreign currency. I just think if you look at it this way, you might be able to see kind of reversing one transaction and recording basically other one, although it's going to a gain account instead of the sale, and you might be able to, that might be easier to tie out in some ways. So in any case, let's record that off. It should do the same thing as we did in our Excel sheet. So we're going to say save it and close it. And the date I want, sorry about that, the date we want here is got to go back to 05/30/31/21/20. 05/31/20, 5/31/20. So I'm going to say this is an adjustment as of the end of the month. Let's save it. Let's close it. Save it and close it. Then if I go back to the balance sheet here and we run it again, we were running. And then we go down. Now we've got our accounts receivable at the 27.3. And then this item down here, which is our adjustment at the 1260. And that then, if I add them together, 27.3 plus the 1260, that's going to give us our 28,560. So that gives us our 28,560, same amount we had then on our Excel sheet. And of course, the amount that would be calculated if we had the 42,000 times the current spot rate 0.68, 28,560. It's also the amount that we would see then on this invoice we created down here, the 28,560. Closing this back out, I'm not going to record this invoice. That was just used to see the rate. And then on the profit and loss, if I run the profit and loss, we then see the unrealized gain or loss. Let's run this here. Oh, here it is. The foreign currency gain or loss at the 1,260. So we got the 1,260 here that's being recorded from this adjusting entry. If I go back to then the first tab, note that these two aren't netted out here, which is not ideal, and it would be nice to kind of have this account right next to the accounts receivable account. The reason I don't do that is that if I set this up as an accounts receivable account, again, then I have to deal with a subledger, and I have to track, it'll be needing to track it by customer, and that adds complication to it. So I think it'd be easier to basically mirror it down here, and then if you need to match things up for distribution out to outsiders, you can then clump it all up into simply accounts receivable, such as this. Or if you wanted to do further breakouts, then you'd have to basically export it to Excel if you wanted to group up the accounts receivable in different ways, right? We got the two accounts receivable in this way. You'd have to export it to basically Excel and then group them together if you wanted to group them up further. But again, I think it's beneficial to kind of separate that out, or it could be, to not get confused. So there we have that one. Now in the future, what's going to happen is we still haven't received the accounts receivable in Canadian dollars. So this journal entry then we made as of the end of the time period. We're going to say at the end of the month, in this case of May 30th. And I recognize that we didn't do it as of the end of March and the end of April. We're just kind of practicing a period end adjustment. So after the end of the period, for the following month, we would probably want to reverse this transaction, and that would be our reversing entry, and then we'll record the normal kind of receipt of the payment in Canadian dollars, and QuickBooks will then be allowed to do its normal kind of thing and record it in the normal process that it can do not quite easily. If we didn't have this cutoff problem, if I didn't care that there was a cutoff in the middle of the year, or possibly I only care about the cutoff at the end of the year, like a 12/31 cutoff where we have this situation, then I wouldn't have to do this entry at all, and we'd have an easier process. We'll take a look at that process in the following presentation.